Okay, so what's the state of the oil market from your point of view?
I think it's probably better than I've seen it in time in the last 10 years. I think OPEC and Russia have really put together a great agreement. It's working. It's all about inventory reductions around the world. Demand's coming back. The vaccine's working. It's a slower pace. Everybody's dealing with the Delta variant, but it's going to roll over, in my opinion. Demand's going to come back stronger the last half of this year and going into 2022.
So in preparing for my interview with you, the questions I kept getting were around hedging. Like for some reason, investors just do not want oil companies to hedge right now. The idea, though, is that you're going to hedge, you're going to lock in an oil price, it secures the kind of money that you're going to get in the future, and that's kind of why people hedge. A lot of analysts say, no, don't do that anymore, Scott. And I talked to Paul Sankey of Sankey Research last week, and this was his question to you. Let's listen here.
But I really don't want any hedging at all from these guys if they really believe in their business model. He's got a variable dividend policy. Why is he hedging away my variable dividend? But I really don't think they should be hedging any of them if they've got a good business model.
What are your thoughts?
Yes, what's changed is that we used to spend every dollar to drill a well, 100% of our cash flow. Today, we're only spending 50%. And so we're going to be distributing over $23 billion of free cash flow back out, and $18 billion of that's going back to the investors. In talking with them, they do not want us to hedge. I think more people think there's more stability in the oil markets today, and the feedback that we're getting is no more hedging. The only hedging we may do is protect the capital budget, but it'll be less than 50%. It may be 20% or 25%. But really, for that variable dividend, which we're paying out a significant amount to shareholders, most of them at this point in time do not want us to hedge.
Scott, great to see you in New York. It's Guy in London. Let's talk about dividends versus buybacks. Oil stocks are trading at a discount right now. Why go down the dividend route and not the buyback route?
In fact, we started the variable dividend about 18 months ago, Guy, and that's through feedback through all of our shareholder base. So we started talking about about 18 months ago, and 99% of them did not want buybacks. They wanted to get the cash, and if they decide to buy Pioneer stock or Exxon stock, they would do it themselves. They want the dividends first. Now, during dislocations, Pioneer is going to have a great balance sheet, and we could easily go into the market and buy back our stock. So if we see a dislocation like we did last year, we could easily do that. Hopefully that dislocation won't happen again. Like I said, I'm more optimistic about stability, less volatility in the oil markets over the next 5 years.
In a just-in-case kind of way, I hear you that investors don't want you to hedge, but would you consider hedging differently, like buying puts instead? So you're not capping upside, but you're protecting downside. Like, is that something that investors and shareholders want right now from you, too?
Yeah, if we saw, I don't think we're going to see this, but if we see a run to $100 for some reason, the problem is it's in backwardation. But if the strip is 5 years, $100, then yeah, you could easily buy a $70 put. That's fairly cheap. But if you buy an $80 put or $90 put, it's too expensive.
I see.
So there's always that one scenario that you could evaluate it.
Scott, can I ask a few sort of operational questions? Are you struggling to get your people vaccinated? How many of them are vaccinated? What kind of price inflation are you seeing in terms of labor and in kit? I'm just kind of wondering what's going on the ground right now.
Yes, our headquarters is in Irving, outside of Dallas. We're 80% vaccinated in our, what we call our Las Colinas office. Out in Midland office, we're 60%, and we're about 35% out in the field. The field's working 24/7, so we're trying to get our field, we're not mandatory yet, but we're close to it. We're trying to get our field to really go out and get the vaccine. It's available everywhere. And as we all know, the Delta variant is much more contagious and spreading. We've seen about a 10% increase from the beginning of the year to the end of the year on cost of inflation. We're building that into our 2022 capital budget.
Is that labor? Is it input costs? Is it chemicals?
No, it's more steel and cement. So steel costs have skyrocketed, especially with this infrastructure bill if it gets passed. I think steel will continue to increase in price. So it's primarily steel. Diesel a little bit with the price of, we're trying to move off diesel for ESG reasons, obviously, but it's more steel and cement.
Interesting.
Are you struggling to hire?
No, not at all. In fact, one of the interesting things is our attrition rate at Pioneer for technical people used to be in the 6 to 8% range. It's down to less than 1%. The primary reason is the private equity firms, they're no longer rating Pioneer or other companies. And so that's a big benefit as to the slowdown and what's changed with private equity. So our attrition rate is the lowest I've seen in probably in 20 years.
Let's go to the M&A landscape. On the call yesterday, you were really adamant that you were not going to be making a bid for Shell's Permian assets. This is a really unfair question. Who do you think will buy it and should buy it, and will the market like it?
Yeah, that's a good question. I saw there was a small deal announced by a company called Callon. They bought
Yeah.
a company today. Their stock's down significantly. So the markets go, I think the market, what's interesting, the buy side wants consolidation, but they don't want you to do it. And so is what I'm seeing. And so whoever buys Shell, they're probably going to have their stock, depending on the price, whoever buys Shell, it depends on what's going to happen to their stock price. I would anticipate their stock's going to fall. But that's just the marketplace. Now, Pioneer has over 15,000 drilling locations. So that's the reason I stated yesterday, we don't need any more. It'll last us for 20 years, all tier 1 locations. So there's no more reason for Pioneer to do any more M&A. So I think the market has it. It's probably the bigger companies. I don't know if it's Chevron or ConocoPhillips, but it's somebody that has to be fairly large to buy Shell's Permian assets.
Scott, one final quick question from me. The regulatory environment is tough. You know this more than anybody else. Do you think it gets tougher from here? I think there was a piece in the Times this morning. I think it was Senator Van Hollen looking at polluter pays legislation, basically asking big energy to step in and fund the bill for all the wildfires and the flooding and the freezing conditions that you know so much about, basically to foot the bill for that. Do you think the regulatory environment gets tougher? Do you think the cost of being an energy company is going to get higher?
Yes, Guy. I did read the article. I've been stating that so far the Biden administration's policies are all based on importing more oil from the Middle East, less from the U.S., as we have reached pretty much North American energy security. In regard to what was proposed by Senators Sanders, I just don't see it's going to happen, to tax Scope 3 from each oil and gas company for the next several years. There's enough senators and enough people in the House, I think, that will stop anything that is that critical to the oil and gas industry. So our industry has probably done the best. People don't recognize it in regard to reducing CO2 emissions and greenhouse gas emissions with what happened to the rise of the gas shale industry. So the reduction of coal has really showed what this industry can do in regard to reducing CO2 emissions going forward.
Scott, last question from me also. Let's just put us all in a nice, pretty bow. What the industry has become much better at is producing more for less and spending less. And I wonder, when you talk about the increases in costs, like with steel and cement, and the possible any regulatory overhang from D.C., what point do you have to start spending more to keep production flat, never mind growing it?
Yes. Excellent question, Alex. We are still seeing tremendous capital efficiency. We're drilling 15,000-foot laterals. We're fracking 2 wells at the same time. We call it simul-frac. And so we're seeing a lot of capital efficiency. So over time, we'll think we'll need less capital to drill the same amount of wells. So that offsets any inflation. So we're still depending on that. So I think that's a big positive that will continue. And that's why we're very strong about saying only about 50% of our cash flow will be spent to grow about 5% a year.